Good morning, everybody. Thank you so much for joining us today for our October version of Coffee with Forethought. Just giving everybody a moment to get with us and join us this morning. Just as we wait to do that, quick reminder that all of the information that Jake and I talk about today is for informational purposes only, should not be construed as individual financial planning advice or investment advice. So please check out our full disclosures online. And of course, your Forethought planner would always be happy to talk about you and your personal situation. So, Jake and I, once again, are very happy to be here with you today to go over what we saw in September. And goodness knows we had quite a bit of news, and including some news to kick off October here. So, this is a fortuitous time for us to be having this presentation today. And just as another reminder, we are doing a live Q&A at the end of our session today. So, at the very bottom of your screen, you will see a nice little Q&A box down there. Feel free to type in any questions that you have during our presentation, and Jake and I will get to as many as we can at the end. Again, we cannot answer your individual questions, but if you do put them up there, we'll make sure that your planner gives you a call or somebody from our office does, and we get that question answered for you. Going over a quick agenda for today, our key topic is going to be all about rate cuts. So the Federal Reserve had their first cut last month, just as we had expected, and we had talked a little bit about last month. But this month, Jake and I really want to dive into what that actually looks like, where we were, where we're going, the effect that it might have on your portfolio, maybe some things that we think you should be taking a look at as far as action items go, and then checking in on how the economy has reacted to that so far. That's, of course, going to take some time, but we'll review it anyway. And then also looking at how those markets reacted. But before we jump into all of that, Jake, the news to start off this month, of course, was the government shutting down. And I want to make sure that we at least acknowledge that for our audience here today, that we know that that's happening. Any thoughts around that or anything that you want to mention before we dive into the interest rates?
Yeah, absolutely. I think this is something that the market kind of freaks out about maybe every 6 months or so. That we might get a shutdown, and sometimes we get kind of a 11th hour resolution. And this time, we actually did go into a shutdown today. So I would just say that we're certainly keeping our eyes on it, but these things tend to be more headline news than they actually are investment implications, if that makes sense.
Yeah, absolutely. Could not agree with you more. I think the last time we actually had a shutdown was quite a few years ago, but these do tend to happen. From our perspective, they do tend to be much more political than economical or even investment related. That being said, we do understand that it is impacting your pocketbooks for some of the folks out there. And so if you are going through anything or want to have a conversation with your planner because of it for your personal financial situation, please feel free to give us a call. Happy to walk through it. But as far as the investment side of things go, we look at it much more as a political stunt than anything else, and we're not making any major changes within the portfolio today because of it. That being said, it's something we're keeping an eye on, and if anything drastic does change, you'll be sure to hear from us. All right, so let's dive right into our key topic for today, which is interest rates. And what we want to start off with is how we got to where we are today. How did we get here? So, Jake, give us a quick history on kind of the rate hikes that we saw back at really starting in about 2022.
Yeah, happy to do so. And to really understand the full context of this, we actually have to go back even a little bit further, kind of to what went on during COVID. And so we have this shock to the system, this exogenous event, right, that nobody could have predicted through COVID. And we had supply chain disruptions. And what the Fed did is they slashed rates and developed this very loose monetary policy, which meant that rates were near zero. We're trying to stimulate the economy to get our GDP back and going. And what also was going on was quantitative easing, which is another tool that the Fed has in their handy dandy toolbox there, where they can actually buy government securities and even agency securities too. They were kind of providing liquidity to anything out there for a time, just to keep the financial markets liquid and flowing. And what that does is it pushes more money. They basically are printing money to push it into the financial systems. This allows banks to continue to lend. it allows consumers to continue to consume essentially and to take on mortgage and all that. And so what that did is, and especially coupled with the supply chain disruption that we saw, inflation really started to spike. And hindsight being 2020, we saw that the Fed was kind of behind the ball there in actually raising rates to combat inflation. In fact, the word transitory was thrown around a lot, that, hey, this inflation here, it's just in the short term and it should dissipate on its own. Well, we know that that was not the case, and is not the case even today. And so what we saw was essentially the quickest Fed hiking cycle in terms of, number one, just going from essentially zero to about 5.5%. But in the pace that we saw it, really haven't seen a cycle like this since the 1980s. And so what this did then is, number one, it kind of like froze the housing market. There wasn't a lot of buying and selling within real estate. So that certainly was kind of paused that market there. But also, as we think about how stocks are valued, right? We often take this approach of, you got to discount future cash flows to a present value. Well, all that means is you're trying to determine a value of the business, and one important part of that value is the risk-free rate. And so when the risk-free rate climbs like it did, we saw a major repricing of risky assets. And especially your growth stocks, a lot of those stocks were severely impacted in this hiking cycle. And so we saw pretty bad performance from that segment of the market, with a lot of those companies still having pretty strong fundamentals and pretty strong growth. Just the multiples they were trading at were impacted just because of this discount rate, being hiked, and there being some more risk in the market. And just remember that the Fed's got a dual mandate. On one side, they want to keep stable prices, and that was what was out of whack kind of post COVID. Whereas the employment, that basically got back to normal, and we got down to really a low unemployment rate. So they could aggressively pursue a hiking cycle in order to try to bring inflation down.
Yeah, and I think you hit the nail on the head there. It really was inflation driven, right? Cheap money, people able to borrow basically whatever they wanted from near zero interest rates. And what I think the biggest impact there, and again, you mentioned this, was really the supply chain. So now we've got way more money in this economy than there are goods, primarily because of the disruption in the supply chain from COVID. And so, of course, we have an inflationary cycle. And the Fed only has those two tools that you talked about, which is interest rates and then how much money they're pumping into the economy. And so they had to go whole hog on both of those things to try to combat inflation. But it really didn't have the effect that they wanted, because that transitory effect that they were looking for didn't happen. They waited too long. And so there's just too much money already in the economy by the time that they started that. And what we really had to wait and look for was much more the supply chain start to work its way back to normalcy, because all of the rest of everything was looking kind of okay. Inflation was the one thing that really stood out as the primary issue when the Fed was looking at what to do with policy interest rates. And so what they ended up doing was holding those interest rates from about July of 23 until for almost exactly 12 months. We had about a 5.5% interest rate from the Fed. At that point, they thought, okay, maybe it's time to start coming down from those. All of these effects had started working their way out of the system. You see in that orange chart there, unemployment had started to tick back up just a little bit. Still not to a point where we would be concerned by it at all, but it started ticking back up. So that was another signal that, okay, this is starting to work. And then those initial unemployment insurance claims, also same thing. You started to see those tick up. So while inflation was starting to finally come down by no effect of what the Fed had been doing other than waiting, it was really, I think, employment on top of that that started to say, okay, maybe it's time to start thinking about this. And so we started to see some interest rates cuts towards the end of 2024. But again, we had those initial cuts, and then we've kind of just been hanging out here for the last 9 months or so until we get to where we are today. And I have this quote here from the chairman himself, which back in August of 25, basically said we're with the policy in restrictive territory, the baseline outlook and the shifting balance of risk may warrant adjusting our policy stance, which is nerd talk for the economy starting to look a little bit different. It might be time for us to start looking at cutting these interest rates again so that we don't run into the same issue that we had back in 2021, where what we thought was going to happen didn't, and we're behind the eight ball with where the economy is going, and we run into the same exact issue where now we're just a dog chasing its tail, and it's kind of already too late to fix the economy before we see the effects of these interest rate cuts. And then we get into the big pivot. So, Jake, you want to talk about kind of what we saw this month, what we expect moving forward, why kind of just dig into this first interest rate cut we just saw?
Yeah, absolutely. And even to kind of tie the last two slides together with this one, right? We saw that Fed speak back in August, and then we basically got tariffs that were announced, right? And so the Fed is also trying to navigate, well, okay, we were kind of at a place where we could probably start to lower rates, but now we're getting wholesale tariffs. We kind of want to pause and see what the data looks like before we make adjustments, because I think the number one concern, if again we look at the balancing of the scales, became, well, inflation could start to run up again due to these tariffs. I think what we've seen, number one, is that a lot of these tariffs, as they were kind of prescribed on Liberation Day, have been since adjusted, and there's still new ones coming to light every so often. But I think what the Fed has grappled with is that, sure, there might be some price impact from these tariffs, but it will probably be kind of a one-time sticker adjustment and not really a sustained inflationary pressure. And I think, Joel, you put it so succinctly of, inflation really is too many dollars chasing too few goods, right? And tariffs don't really cause that, right? Especially if there's not money being pumped into the system and consumers looking to still consume at or above where they had been before. So I think that as we saw some data come out, we also started to see the unemployment rate continue to tick up a little bit more, and also the continuing claims for unemployment insurance really started to increase from kind of February to August, when they did drop the level there. So essentially, what we got in September was another 25 basis point cut, which brought us from 4.5 to 4.25. They also opened the door for more additional cuts that are likely to come. And in fact, looking at the futures markets, where people are kind of making educated bets on where they think the Fed target rate will go, it's looking like right now like a 99% chance of an October cut as well. While at the same time, though, we'd be remiss not to include that the second from the top chart there, which is the US CPI, or the inflation rate, which has, it looked like it was continuing to fall down, but it's crept back up to that 2.9% level. We are still above the Fed's target. There's no way around that. However, when you look at the balance of risks, I think, again, the Fed is seeing more risks on the labor market side than they are on the inflationary front.
Yeah, absolutely. So what we want to do is, like Jake mentioned, and we're not prognosticators, so we're not going to tell you how many rate cuts, but let's hope for my mortgage's sake, we get some more, because gosh knows I could really use a better interest rate. But let's talk about what these cuts are actually, what the impact is to the markets overall. And let's start by talking about, I'm going to talk about bonds, and then I'm going to throw it back over to you, Jake, and what you think stocks might be doing here. But as many of you know, maybe some of you don't, is that when interest rates start to fall, they have an inverse relationship to bond prices. So as these interest rates begin to decline, bond prices are going to start to increase, and you'll start seeing that effect almost immediately inside of the bond market. We haven't seen a major impact yet because it was only a 0.25 basis point cut, and we're going to check in on the bond market in a second here. But just remember that inverse relationship. That's one of the things to be looking at. The second there, rates begin to adjust, and by that we mean borrowing rates. So mortgages, car loans, credit cards, those interest rates that we've seen at decade highs recently have started to come down a little bit. Those are market driven rates though. The Federal Reserve can only control the short end of the curve. They don't control the lending market. So while they tend to follow each other, it's not an immediate impact. So we're not going to see mortgages go from 6.5 to 6.25 right away. But eventually, especially if they continue to cut rates, you'll see those borrowing costs come down. And so that's one of the things you'll want to keep an eye on for your personal situation. And then the last one, and potentially most importantly, before I throw it back to you, Jake, for the stock market there, cash yields begin to fade almost immediately. So your bank is so nice to you that when interest rates are increasing, they take their time to increase the rate that you're going to get on your cash. But when they come down, they slash them. And it's almost an immediate impact. I'm sure you're already getting notifications from your savings account. But we've seen our cash go from, call it about 4% or so on average, down to about 3.75 already. And so you're going to continue to see that inside of portfolios, that cash coming down, which means you're no longer going to be keeping up with inflation potentially, because like we just looked at, inflation is still close to 3%. So if they continue to cut rates, cash is going to be less economical to hold inside of a portfolio. And so one of the things we are looking at for clients is locking in rates now, potentially, depending on your situation, because cash is no longer a safe haven or a place where we can be patient if they continue to cut rates. We're still okay for now, but you're going to continue to see that happen as rates potentially continue to fall here. So, Jake, tell me a little bit about what you think stocks might do to react to these interest rate cuts.
Yeah, I think there's sort of a technical perspective to it, and then there's kind of like a behavioral perspective to it. And the technical side of it is kind of what I already alluded to a little bit, in that one way to price an asset is to kind of use a discounted cash flow type model, right? And not to get too in depth into it, but one of the crucial components of that model on the denominator would be a rate, a discount rate. And that's one way going to be directly reflected to the risk free rate. And so as the risk free rate drops down, that means your denominator gets smaller. And then that means that overall the value of your company or your asset should go up. And that's keeping everything else equal, which it never happens, right? Those other factors change every single day. The other component to it, though, is as rates come down, that means that companies are more likely to invest in projects that hopefully are positively kind of cash flow drivers for them. If rates are very high, they're less likely to go out into the bond market, issue debt at those high rates in order to pursue a project. It just might not be profitable there. But as rates come lower and lower, these high quality businesses that have pretty strong credit ratings can achieve better and better financing terms. And that can lead to more economic activity and more business activity. So that's, on the more technical side. I think on the more behavioral side, you have, I think that one thing we talked about already, kind of with the cash yields or money market yields going down, we are looking to, as Joel mentioned, like lock in yields, and one way to do that is through the bond market. But other investors might look at this as an opportunity to get out of cash or money market and get into equities as well. Not exactly something that like we would recommend or not. It depends on a client situation, but kind of wholesale, that is a dynamic that can happen. And when you have more demand coming into the equity market and more buyers than there are sellers, that can also lead to prices increasing there on the equity market side. So I think on kind of a general term, when there's a rate cutting cycle, it's generally positive for equity markets. I think that's fair to say. Now, that said, there are risks to that. We're already trading, the equity markets are at a pretty high multiple already. And we always talk about how the stock market is forward looking, right? And so when we're looking at moves that the Fed is making today and maybe even next month, that's probably already, it certainly is already being reflected in stock prices today. So we're not necessarily saying that, you should see this huge jump in equity markets or anything like that. But generally, the trend is positive for risky assets like equities and like real estate.
Yeah, absolutely. The way I like to think about it for my clients when I've got my portfolio manager hat on is if I only have a dollar, right? I have finite number of dollars that I'm allowed to allocate. I need to look at the return that I'm getting from that dollar and whether or not that return is enough for my clients to be able to maintain their lifestyle over time, taking into account inflation and all those other things going on. And so if these yields start to come down, you hinted at it there, if that return's not going to be there in the fixed income market, which is definitely less risky, generally speaking, than the stock market, that tends to push clients towards the stock market because that's the only place where yield is. I remember when I first started over 10 years ago, the stock market was the only game in town. We had bonds at near zero, and so we couldn't have that allocation and keep up with inflation. And that's what I worry about a little bit. I don't think we're going to get back there. What I'm hoping for is a much more normalized stock bond market where we'll have a much more normalized portfolio as well for our typical client. But that is always a worry. If we have to go back to zero interest rates, are we going to have to take on undue risk in client portfolios? Always something that we're battling with and taking a look at for our clients. But with all that being said, let's take a look at how the markets actually did react to this interest rate cut. So what we've got here, of course, is our yield curve. You've seen it before, you know it, you love it. And we're looking at 3 time periods. We've got the dark blue, which is just as of today. We've got the orange, if we want to call it that, the burnt orange there, which was a month ago. And then we've got the gold or the yellow there. That was 1 year ago. And what you see is there really wasn't much of a change from a month ago, even, and primarily that's because the market had this priced in. We knew for the most part this was coming. It was like a 98, 90% chance. So the market was anticipating that. But where you see the biggest move there is on the front end of that curve, where we went from about a 4.5%, of course, down to closer to a 4.25% interest rate. And that's because that's the part of the curve that the Federal Reserve can control. That is almost a direct impact by their decision making. So that's where we would expect to see it. The rest of the curve will adjust over time. That's primarily going to be based off of market sentiment and where we think the Federal Reserve is going to continue to go with these cuts. And it's going to be all those things that Jake was talking about: unemployment, it's going to be CPI, it's going to be the tariff impact, it's going to be all of those variables coming into play, and the market will price out the rest of this curve here. But that very front end there, where we see that giant drop, that's the point of the curve where the Federal Reserve has control. Jake, you got anything to add to that?
No, I think as we get into the next slide, one thing that Joel, I'm sure you hear it a lot, but it's kind of like a misnomer or a misrepresentation that just because the Fed is going to cut rates, well, that means that my mortgage rate or the mortgage rates on market are also going to have a 1-to-1 cut as well. And I think this slide really dispels that. And I'll try to lay out what the different lines are here, right? Starting with the orange and the light blue. This is my Florida Gators colors right here. But these are mortgage rates. The orange is a 15-year, and the blue is a 30-year mortgage rate. And what we should see and what makes sense is that these move directionally just about the same, right? When one's going up, the other's going up. Might be a different spread there because, a 15-year mortgage rate should be lower than a 30-year mortgage rate. But directionally, very similar, very high like correlation there between the movement of that line. And the light green line is a 10-year treasury rate. So this also has a very similar path. When we look at when the orange and blue are going up, oftentimes the green is going up. When the other two are going down, the green is going down. And that's because the mortgage market and mortgage rates are much highly correlated, a lot more highly correlated to the 10-year treasury rate than they are to the federal funds rate. And that is the purple line, which you see looks a lot different than the other two. And I think it's always, important to come back to the idea of like correlation versus causation. I had a statistics professor who really gave me an analogy that I just couldn't forget, and he said that there's a high correlation between a number of ice cream scoops eaten and shark attacks. Okay. However, eating ice cream does not cause sharks to attack you. It just so happens that more ice cream is consumed in the summertime when the weather is nice, and also more people having to be happen to be swimming or going to the beach and swimming when the water is nice, when the weather is nice as well, and you can't really get bitten by a shark on land, at least to my knowledge there. So an important reminder that correlation does not equal causation, and it's important to know that, hey, just because the Fed is going to cut rates, that doesn't necessarily mean that mortgage rates will follow that path, period, or that it will happen immediately. There could be an instance where the longer term treasury rates are going in the opposite direction, maybe because the investors of our treasury bonds are getting more and more nervous because our deficit is rising, and they're requiring a higher yield to be compensated for that risk. And so we could see an environment, not that I'm calling for this, but it could be feasible where the Fed is lowering rates, and so the federal funds rates is declining, but mortgage rates are staying steady or even going higher because they're more tied to the longer end of that curve. Now that would be a little bit of an abnormality potentially, but just wanted to kind of dispel that rumor out there, or that people always talk about. Hey, the Fed's cutting rates, and kind of correlating that to what it means for the housing market immediately, or to their mortgage immediately, because at the end of the day, it at least will take time for that to kind of seep into those markets.
I had never heard of that correlation before, but I will be eating less ice cream next summer. And so my mortality risk and my waistline both thank you, Jake, for that one.
You're very welcome.
But from a planning perspective, just real quick, we get the question all the time, especially from the younger generation, our generation, Jake, where is now the right time to be buying a house? And my advice is always, it's the right time to buy a house when you're ready. We do not base that decision based off of interest rates because, again, we have no control over what that's going to be. But your personal financial situation, I do. And so the little term that I always like to use is we date the rate, but you buy the home. If you're ready to buy a house, go buy a house. And then if the interest rates seem to fall or do fall afterwards, we can always refinance later and we're happy for it. But that's a personal decision. You should not be making that decision based off of what the Federal Reserve is doing with interest rates. So just wanted to throw that out there. And then let's go ahead and do a quick check-in on the stock market. And we can kind of breeze through this slide because nothing really happened. If you look at the left-hand side there for the month of September, if you can tell me where the interest rate cut was, I'll give you, I'll be happy for it. But the market really didn't react overall, in my opinion. I mean, we had some intraday movement there, but again, the market is forward looking. We basically had this priced in. The cut happened. Some people sold, some people bought. The algorithms kicked in, but the economy kept chugging along, and the stock market did relatively well over the month of September across the board. What we saw there, though, of course, was the underperformance in the international. And if you've been with us for the last few months, you know that international has been the best performer year to date, still is, but it was the underperformer in September. And so diversification continues to work. And the one on the right there, Jake, and I'll let you kind of chime in on this portion. We're seeing the momentum trade back in action. You talked about this a little bit earlier, where when rates are starting to cut, that tends to be good for the stock market overall. I think that's exactly what we're seeing, which is this momentum trade is back on. It's not really fundamental based, but it's just more dollars flowing in, so markets go up.
Right. I mean, I think the only missing link, and especially that we saw over the month of September, is we did have a lot of earnings results there, especially from our large cap Nasdaq constituents, technology innovation companies, and the earnings continue to be very strong for those companies. So that I think was more of the what drove the market, and less that, hey, we got the rate cut that we had all been expecting for a couple of months at this point. But the one thing that I will speak on here is just if we really do zoom back and look over, like a 5 year period, let's just say, the growth stocks, like if we look at that Russell 1000 growth, I mean, that market and that index has annualized over 16.5% over the last 5 years. I mean, just looking at longer term market cycles and all that stuff, I mean, that's just flat out not sustainable, right? And we're getting into a position where we're, cutting rates. And I agree with you, Joel. I hope that we don't get back to zero, right? That wouldn't be, I don't think, healthy at all. But even if we get back into kind of a normal, neutral policy target, those comps are going to be tough to lap. And I think the bigger risk that is a tail risk, but I think is getting to be a little bit of a higher probability, is getting into more of like a stagflation environment where stagflation, that just means that we have higher inflation but no growth, and that oftentimes leads to higher unemployment too. And that would really put the Fed in a little bit of a bind, because we got inflation working against them and unemployment working against them. And as Joel mentioned, the only two tools that they have, if they do one thing, it helps inflation but hurts unemployment. If they do the other thing, it's the opposite result. So I think that is a tail risk that we're keeping in the back of our mind and certainly, adjusting for. But with these growth companies, they are phenomenal. You don't want to be missing out on those companies. But really looking to lock in yields, I think, in high quality bonds makes a lot of sense right now. Again, not recommending this for any clients, but just where I see, as Joel mentioned, like you have a dollar to put to work, and you want to take in some of the context behind these different asset classes. These are a couple of things that our investment committee is having, robust conversations about today.
Yeah, rebalancing is always important, especially in markets like with what we've seen there. So our last couple slides here, we'll kind of go through them fairly quickly for sake of time. But of course, we want to check in on the Holy Grail and look at how the economy's doing. And like we mentioned during the interest rate conversation, we're kind of still kicking on all cylinders here. We've got some things that are a little worrisome, but nothing in the red right now. But of course, housing continues to be something that we're keeping an eye on. We'll see what interest rates do there. That's going to be tied to the 10-year, like Jake was talking about, and what happens with mortgage rates. But if those rates come down, helps with housing affordability a little bit. Labor continues to be a concern. We've seen a slight uptick there. It's still not in a territory that we're out of sync with expectations or where we would want to be. And then GDP also, of course, there's been some definite lumps in GDP over the last couple of quarters. And so we're going to keep an eye on that and see what happens as this works its way through the economy. What does that real GDP number look like moving forward? And so, final slide here, just some general ideas to consider. A lot of what we've already talked about here, but if you have a plan with forethought, stick to it. We take into account all of these fluctuations. Like Jake talked about, our team is looking at things that we should be doing, primarily just rebalancing, and it's going to be rebalancing back to that long-term plan. If stocks have outperformed bonds, we should be trimming stocks to buy more bonds because your allocation is out of whack. Very easy and simple things like that we know are tried and true. Even in times where we're going through a change in the economy, they still hold true through that. Review debt opportunities. So as interest rates come down, they haven't yet, but car loans, if you have them, mortgage rates, certainly for folks, especially our age, Jake, I know as soon as it gets below where I am, I'm going to be the first one at the bank looking to refinance that baby. But things like that, just look for opportunistic chances to refinance any high interest debt that you might have out there as rates come down. Jake, you want to talk about not reacting and investing?
Yeah, absolutely. I think that's one thing that we really preach here is that we look at the long term and we don't try not to speculate. And reacting is kind of the opposite of speculating, right? Speculating is you're thinking that something way out there is going to happen, and you're trying to profit from that without really seeing any proof of concept, right? Whereas reacting is you wait until the proof of concept is already well established before you make that move. You have to have a balance there, because if you're only reacting, the market's already moved and has already reflected that information, and it's very efficient at doing so. And so you really need to have, again, going back to your plan, and striking that balance. And then the last one, as Joel mentioned, right? Consider locking in your fixed income allocation. We've had, we've seen clients with like, hey, while I'm earning 4+% in money market, might as well do that when there's not really a reason to lock in bonds, and I already have my equity allocation. It's time now, because when the market, or when the Fed cuts, that's an immediately a reduction in the money market rates. And so locking in those bond yields where they're at today, we think makes a lot of sense.
Yeah, great. And so with that, everybody, thank you so much for joining us today. We ran a little bit long, but it was an important topic. We wanted to make sure that we gave it the time that it was due. We're going to go ahead and move over to Q&A here for those who want to stick around. But just as a reminder, if you know anybody that might find any of this helpful to them, please feel free to share it with them. This is free for our clients and guests, and we'd be happy to have them join us next month. We do it every Thursday at this time, first Thursday of every month. And so please share it with family, friends. Love to have them join us. And if you have any specific questions about your particular situation, give us a call. We are happy to help walk you through your personal situation, how this might apply to you, and any changes that we might see in your portfolio. But with that, let's go ahead and move over to some Q&A. I'm sure we've got some good ones.